Let's talk about a situation every investor knows. You find an amazing company, you're ready to invest, but you just can't shake the feeling that the price is a little too high. Well, today, we're going to dive into a powerful strategy that doesn't just help with that problem, it actually pays you to be patient. I mean, this is the classic dilemma, right? You've done the research, you love the company, but you look at that stock chart and you just think, if I could just get in a little bit cheaper. So you wait, hoping for that perfect moment to buy. But here's a thought. What if that waiting period wasn't just, well, waiting? What if you could actually generate real income, I'm talking cash, in your account, just for agreeing to buy that stock at the lower price you wanted anyway? It sounds kind of wild, but it's totally possible. Okay, so here's our game plan. First, we'll talk about the magic of getting paid to wait. Then we'll break down exactly what a secured put is. After that, I'll walk you through a simple 3-step playbook. We'll look at the 2 ways these trades can end, get real about the risks, and finally, see how this all plugs into a bigger income strategy called the wheel. So picture this. You've got your eye on a top-tier company, a real blue-chip stock you'd love to own for years. You know, something like Meta or Costco. You're bullish on the business itself, but the price today just feels a little stretched. You're confident, but you're not in a hurry. Now, your first instinct might be to just set a limit order and hope the stock dips, and that's fine. But with a cash-secured put, you can do something so much better. You can turn that passive waiting game into an active income stream. All right, so what is this tool that lets us do this? Let's get into the nitty-gritty of the cash-secured put. So here it is. With a cash-secured put, you sell an options contract, and in exchange, you get paid a cash premium right now, today. For that cash, you take on an obligation, but it's an obligation you choose. You agree to buy 100 shares of a stock at a specific price, called the strike price, by a specific date. And the secured part? That just means you have the cash ready and set aside to make the purchase, just in case. You know, the best way to wrap your head around this is to think of it like you're selling insurance. Another investor out there is nervous their stock might fall, so they pay you for protection. You collect that insurance payment, the premium, and you agree to buy their stock if it drops to that price you set. You're basically getting paid to take on a risk that you actually want to happen. Let's break down the deal. 1, you get paid cash right up front. 2, in return, you agree you might have to buy 100 shares of a stock, but here are the best parts. 3, you set the purchase price. And 4, you set the deadline. You are in control of the terms of this deal from the very beginning. Okay, that all sounds great in theory, but how do you actually do this? How do you put on your first trade? Well, it really just comes down to a simple, repeatable 3-step playbook. Step 1 is by far the most important. You have to pick the right stock. And this isn't about finding some random high-flying company. This has to be a business you genuinely want to own for the long haul. And of course, you gotta make sure you have the cash set aside to actually buy it if you have to. This is the golden rule. Never forget it. Step 2 is all about picking your price. You'll look at what's called an option chain and select your strike price, which is just the price you're agreeing to buy the stock at. Generally, you'll pick a price that's below where the stock is trading right now. This gives you a nice little buffer, a margin of safety. And finally, step 3, my favorite part, you get paid. You go into your brokerage account, you sell to open the put contract, and the second that order fills, bam, the cash premium hits your account. It's instant. You get your money right at the start of the trade. Okay, so the trade is on, the money's in your account. What happens next? Well, when that expiration date rolls around, there are only 2 ways this can play out. It's a fork in the road. And this is where the strategy is just so beautiful. On one hand, if the stock price stays above your strike price, the option just expires worthless. You keep the entire premium free and clear. It's pure profit. On the other hand, if the stock price drops below your strike, you get assigned and you have to buy the 100 shares. But hey, that's what you wanted to do anyway. And your actual cost is even lower than what you agreed to because you get to subtract the premium you were paid. So it's a win-win. Either you get paid for doing nothing or you buy a stock you love at a discount. Now, a win-win scenario like that can sound a little too good to be true. And that means it's time for a reality check. We absolutely have to talk about the risks involved here. Let's not mince words. The risk here is real. As James Boyd from Schwab Coaching puts it, the risk is the stock could fall all the way to zero. When you sell a put, you are taking on the exact same risk as if you just bought 100 shares of the stock outright. See, that contract is ironclad. You are obligated to buy the stock at your strike price.
It doesn't matter if the company has a disastrous earnings report and the stock plummets overnight. If it closes below your strike price at expiration, you're buying it at that price, period. Just look at this example. Let's say you agree to buy at $170 a share, but then disaster strikes and the stock tanks down to $130. Well, you still have to buy it at $170. That means you're immediately looking at a $40 per share loss on paper. And this is exactly why that golden rule is so important. You must be willing to own the stock for the long run, through thick and thin. But what if getting assigned the stock, even at a paper loss, isn't the end of the road? What if it's actually just the beginning of the next phase of an even cooler income strategy?
Right. So, for a lot of people who use this strategy, getting the stock isn't the bad outcome. It's actually part of the plan. You wanted to own it, and now you do. In fact, acquiring the shares is what kicks off this awesome cyclical income machine known as the wheel.
The cycle is brilliant in its simplicity. You start by selling a cash-secured put. If you get assigned, great. Now you own 100 shares. Step 3, you immediately turn around and sell a different kind of option called a covered call against those shares, which generates another premium. A covered call is just an agreement to sell your shares at a higher price. If they get sold or called away, no problem. You're back in cash and you can go right back to step 1 and sell another put. The wheel just keeps on turning.
And that's the whole idea behind the wheel. By combining these two strategies, selling puts to get in and selling calls once you're in, you can create this consistent churning flow of income, all based on a foundation of great stocks you wanted in your portfolio from the very beginning.
So there you have it. You can literally get paid to be patient. It completely changes how you look at investing. The question now isn't just about what stocks you want to buy. It's about which stocks on your watch list you'd be happy to get paid to wait for.